okay, the seller is offering $20,000 to buy my rate down. What if I just wanted to use that to my closing cost? I mean, I can use that money in other ways. Why should I do this temporary rate buy down? I put a lot of work into this and really think that I will have a good production here today, or a good video, a good explanation today if you're interested in learning about temporary rate buy downs. How do they work? What you should know about them, what kind of decisions you have to make, should you engage in one or not, what are the opportunities there, what are the risks, what are the pitfalls. So that's what this video is about. Welcome back to the Mortgage Mastery Theater, sponsored by Cleveland Street Mortgage. My name is Chris Buydowns, and here we go. First of all, just kind of a basic understanding, what is a temporary rate buy down? And the first thing I just want to point out is it's a little bit of a misnomer. The name itself is a little bit of a misnomer. They call it a temporary rate buy down, and you're actually not buying down the rate at all. The actual, if you look at an amortization schedule on your loan, the actual interest that you're incurring is whatever your note rate is going in, not the bought down rate. So what is the difference? Basically, what this temporary rate buy down is it's an agreement for someone, and it can be the seller, it can be the lender, it can be yourself, to put a deposit in escrow to subsidize your monthly payments, for a fixed period of time, 3 years, 2 years, 1 year. And basically the amount that they deposit on escrow is enough. Let's say it's a 1-0 buy down. So they're going to buy the rate down 1% for 1 year. And so what they'll do is they'll say, okay, if you're starting out at 7%, that's your actual note rate. What would the payment be if your note rate was 6%? And whatever the difference is between the 7% payment and the 6%, they're going to calculate that difference and multiply it by 12. So there's 12 monthly payments where they're going to deposit that in escrow and say, lender, I want you to take 1/12 of that out every month and apply it to my borrower's mortgage payment. And then my borrower will pay the rest. And so it's as if you had a lower interest rate from the payment standpoint, but your interest is still accruing at the regular rate. Maybe that's a subtle point, and not necessarily, maybe that's a distinction without a difference. But I think it is important to know that you're really not buying down the rate. You're just depositing funds to subsidize your payment as if the rate were lower for that fixed period of time. And so but the basic understanding is just that. Somebody is depositing money with escrow so that you can make a lower payment than the actual note rate would require for some fixed period of time. And here I've got on the screen right here, just a basic buy down calculator, and you can kind of see how it works, just fundamentally how it works by looking at this. Before I kind of get into that, I want to kind of ask the question: is this a gimmick? Is a temporary rate buy down a gimmick? And that can be a very subjective question. But fortunately, I've got my handy meter here. This is my gimmick meter, and we're going to see what it says. With temporary buy down. Yeah, what's it say? Oh, it kind of rates high on the gimmick meter. Man, that's so high that you can see it kind of burned the hole in the middle of my gimmick meter. So just because I think it's a little bit gimmicky, maybe a lot gimmicky, doesn't mean you can't benefit to the tune of thousands of dollars with it. So don't stop watching now because it's a gimmick. There are very important decisions you can make, and literally you can save thousands of dollars by understanding it. And making sure you do understand it. So, why do I say it's a gimmick? Why do I say it's a gimmick? Well, because what you're doing is you're just taking a pile of money, and that's yours otherwise, that you have access to, and you're setting it aside and saying, okay, for the first 12 months on this mortgage, I want to make a payment as if I had a lower payment. But I'm taking that money, and let's say you were to do that with your current mortgage. Let's say you are sitting at a 7% mortgage right now. You're not refinancing. You're not buying a new house. You're just sitting there, and you go, you know what? We're going to be a little tight for the next 12 months, and I want to save some money. So I'm going to take some money, and I'm going to put it in savings. And I'm going to put X thousand dollars in savings, and every month I'm going to take $300 out of that savings account, and then $300 out of my regular checking account, and that's how I'm going to make my mortgage payment. And somehow that's going to make me feel better about my mortgage or make my budgeting better. So it's a little bit gimmicky that way, because that's essentially what you're doing with a temporary rate buy down. It's just that sometimes other people's money are available to do this, and that's really where you can kind of take the benefit of it. But otherwise it's kind of like those, you see really young kids when they first learn how to play hide and seek. They think that if they kind of cover their eyes that nobody can see them. They think, oh, I'm covering my eyes, nobody can see me, I'm hiding because I can't see everybody else. And this is kind of like that kind of a thing where you're really not fundamentally changing anything by doing it, but yes, there's some things the ways to benefit from it. And so let's talk about it. Make sure you do understand it, because there are some very important decisions to make and some mistakes you want to avoid with regard to temporary rate buy downs. So first of all here, let's just look at this chart here, and I want to show you basically how it's calculated. So in this case, let's say the going rate is 7%. That's the going rate, and I have here a $500,000 mortgage and $1 million purchase price. Doesn't really matter here. 50% loan to value. And what's important here is you see what's the monthly mortgage payment. It's going to be $3326.51 on a 30-year or 360-month mortgage. And what I'm illustrating here initially is a 3-2-1 buy down. And what that basically means is 3 is what the percentage rate reduction is going to be for the first year, or assumed rate reduction is going to be for the first year. So it's going to be 3% below the actual note reach, which is 7%, right? So you see this first year, year one, we're going to pretend like the rate's 4%. The payment would be $2387.08 or $939.44 less than the actual note rate. And they're going to multiply that by 12, and that's going to cost $11,273. But this is not just a 1-year buy down, this is a 3-2-1, so it's a 3-year buy down. And these aren't going to be super popular, partly because you can see that the total cost of that's $23,000, and so they're not going to be super popular, but you might see that. And so that's $23.97. The second year, it's going to pretend it's 5% for 12 months. It's going to be $26.84, $642 less. That's going to cost us another $7,700, and then $3,900 for the third year, when we're going to pretend it's 6%. And then, of course, in year 4 and onward, you're going to make your full payment. But somebody's got to come up with almost $23,000 to deposit into the escrow account with the lender in order to fund this 3-2-1 buy down. And that's really kind of the essence of it. Where all the nuance comes in, decisions come in, and pitfalls come in is kind of who pays for it, how you pay for it, understanding kind of how it works. And that's what we're going to get into here going forward. So let's go to the payment method comparison. And there's basically 3 ways to pay for a temporary buy down. You can do it with the seller paid, and you can do it with the borrower paid, and you can do it with the lender paid. Right? Those are the 3 different ways that you can pay for a temporary buy down. And so the question here, I'm talking about the feature and how the different payment methods compare or interact with that feature. So overall usefulness, I would say seller paid is kind of the only one, and this is kind of where my point earlier about even though this is gimmicky, there's money to be had and made potentially on this, is because this is something that listing agents have been telling their sellers to say, let's offer a temporary buy down. Instead of lowering your listing price, from $1 million to $950,000, let's just offer $1 million and offer to buy their rate down with a 3-2-1 buy down. We'll put $20,000 in. So instead of lowering their price by $50,000, they're willing to pay $20,000 or so for a temporary buy down. And basically why I say this is useful and something to be aware of is generally, this, sometimes they'll advertise this on the listing itself. It's not something you even have to negotiate for. It's just in the listing saying, seller willing to pay X thousand dollars toward a temporary buy down. And so it's kind of low seller resistance if they're offering it anyway. Now there are other ways, other things that you could do that money, right? You could look at that and say, okay, the seller's offering $20,000 to buy my rate down, but what if I just wanted to use that toward my closing cost? I mean, I can use that money in other ways. Why should I do this temporary rate buy down? And that's a great question. The challenge you may have with that is a couple of things. One is, if you're in any kind of a competitive market, or you're just in a situation where you think, they're offering this, I want to go the path of least resistance to grab that $20,000. And so I don't want to counter with some other way of taking that money from the seller, even though the seller is going to be the same either way. If he pays $20,000 towards your closing cost, or if he pays $20,000 as a deposit of temporary rate buy down, he's going to net the same, and you really shouldn't care. But maybe you don't want to put another wrinkle in the negotiations. You just want to take what they've offered. The other thing that you've got to watch out for if you think, well, I could just use that money toward my closing costs and prepaid expenses, is that you won't necessarily have $20,000 in closing costs and prepaid expenses. And most of the verbiage when you negotiate a seller contribution towards your closing costs and prepaid expenses will say something like up to $20,000 toward the buyer's closing costs and prepaid expenses. And then you're sitting with a situation where you go, well, I've only got 12 grand or 13 grand, so I've got 7,000 left over. Now you can use that, you can go buy the interest rate down, but you're being forced to buy the rate down with the extra money that's on the table when maybe you wouldn't have spent the money that way had you had complete freedom as to do with that money whatever you want to. Maybe it's a bad idea to buy the rate down, right? Because maybe in the future rates are going to come down anyway. So why are you going to pay money to do that? So anyway, that's one of the. That's why I call this somewhat useful. Reasonably, it's something that is not infrequently on offer in the marketplace. You'll see it on many listings or in negotiations. It's something that buyers, sellers have been prepared for. Their listing agents have told them, look, instead of lowering your price, let's be prepared to offer a seller contribution to do a temporary rate buy down. And in their minds, they're thinking that means I can offer less and lower the price. And so they're kind of primed to do this. So I find it useful. Now the borrower page, you see I've got nil, right? And that kind of goes back to that illustration of that, that little very young child playing hide and seek and kind of going like this. Why would you ever take your own money and put it on deposit in escrow, right? If you're going to do that, if you're going to play that game, and that maybe you have reasons for doing that. If you're going to do that, just put it in your own savings account and grab it out every month. Don't complicate the lending process and put your own money on deposit with the lender so that then they can pay it back to you on a month-to-month basis in the form of lowering your mortgage payment for X period of time. So really, it's and the other thing here is that it's almost it's almost non-existent in the marketplace. Hardly any lenders offer borrower pay. And the reason for that is this thing here is it's the only one of the payment options that's charged against lenders' allowable fees. Lenders are regulated on how much they can charge you on any given loan. It's based upon a percentage of the loan amount, percentage of the purchase price. And these costs, even though they're coming out of your pocket, you're paying it to the lender, they count against the lender's allowable fees. So then they can't charge their normal fees, their normal expected compensation for the deal. So you'll almost never find that out there anyway, even though it's technically possible. The forms allow for it, the Fannie and Freddie allow for it. Almost nobody's going to do it that way. And even if they would, I just don't see the point of that. Now, lender pay, and again, this is a little bit of a misnomer as well, because lender paid basically just means that the lender says, yeah, I will make this deposit on your behalf, but I'm going to adjust your loan cost. So, it's really kind of, as you'll find, lender regulations, government regulations in general are big on form over substance. And you'll get some things that are substantially the same thing, but they'll treat them different because of the different form. And this is one of those. Borrower paid, this is called lender paid. But so the lender takes money out of their pocket, but they increase your either your rate or your fees or both to compensate themselves for taking that money and putting it on that behalf. So they're really not paying it. You're paying for it, but you're typically paying for that through a rate adjustment. They're going to increase the rate, and then they're going to take the money that you would otherwise give for taking a rate that's above market, because you can do that, right? Anytime, forget about the temporary rate buy down. Anytime that you're locking on an interest rate, you have a par rate where they're not charging you points and they're not paying you anything. And if you take a rate that's above par, you're basically saying, look, I'm willing to take a higher rate if lender, you'll pay some of my closing costs. That's what you're doing here in this situation. They'll do a rate adjustment. But now, now we're, in order to give yourself a temporary, however, 12 months or 24 months, however long that buy down period is, you're taking a rate adjustment, and that rate adjustment's permanent. Until you pay off that loan, that rate adjustment's permanent, either through a refinance or sell or just pay it off. But that's a permanent rate adjustment. So the cost keeps going on as long as you have that loan. And so it's just lender paid. It's very limited value. I don't know why you would do it. But it's an option that's available to you. So let's talk about the cost. And we've kind of hit on this already, but the cost is dollar for dollar. Here we saw the cost, and we're just literally saying, okay, what would the payment be at 4% versus what the actual payment requirement is at 7%, we're going to take that difference, multiply it by 12, and we're going to put that in there. So there's nothing really magical about the cost or how that's done. It's just dollar for dollar, whatever it takes to put in that account to make you feel, to lower the amount you otherwise have to pay for that fixed period of time. And that's just what it is. And it's the same for lender paid, for seller paid, for borrower paid. And as we saw before, for a lender paid, it's not that way. It's generally done through a rate adjustment. Now you can just keep the same rate and have the lender charge you that additional cost. But again, I just don't know why you would do that. Then you're literally just as if it was borrower paid. You're just putting the dollars into the loan, taking them out of your pocket, putting them into the lender's pocket. And the worst case about the lender situation is why you would never ever do that, is because this is the only one that's not refundable, right? And this is where kind of the seller paid, borrower paid, I'm just not going to talk much more about. I've already kind of belittled that enough, right? But the seller paid, the beauty of the seller paid here is these funds are fully refundable. So let's say you put $20,000, you get that 3-2-1 buy down, and it's supposed to last you 3 years, right? 3% the first year, 2% the second, and you're getting the actual dollar for dollar benefit from that every month because the seller put that money in, and it just lowers the amount you have to pay on your mortgage payment for that period of time. So you're really getting the dollar for dollar benefit. But let's say that come 6 months from now, interest rates have come down, and now you can refinance at 6% for a very low cost, and you're thinking, yeah, but I've got I've got $13,000 left in my temporary buy-down account. What's going to happen there? Well, that's fully refundable. So you pay off that mortgage, whatever's left in that account is just like any monies, you pay your taxes and insurance as a part of your monthly payment into escrow. That escrow balance, whatever's there when you refinance that loan or when you pay off that loan, all that money's yours. Same with the with the temporary buy-down deposit that's there. That's all your money, right? So now I say, is it refundable? I say yes, but verifying, and the only reason I say that, I read a little bit of the verbiage. It seems like there's some flexibility on that. I've looked at the Fannie and Freddie forms, and we'll look at that in a little bit too. And it's very clear on the forms that I've looked at, on my particular lender's forms, that they're that they are refundable. But just we'll show you where to look on the agreement because you do have to sign a temporary buy-down agreement, part of your mortgage forms. When you execute a temporary buy-down. So you're going to sign that agreement, so we'll take a look at that. So here we talked about, is it charged against lender's allowable fees? Seller paid, no, because the seller's paying that, so it doesn't impact the normal fees that a lender can charge you. It is here. It's not charged against you here. Again, that's that form over substance. Even though you're really paying for it, it doesn't count against the lender's allowable fees. Does it increase your qualification potential? No. A temporary buy-down doesn't, even though that first year you're going to make a payment as if you had a 4% rate instead of 7%, and you think, wow, you could handle a lot more with that lower payment, but it doesn't. They don't qualify you that way. They qualify you based on the full 7% interest rate, and that is the same whether you're going to be lender paid, borrower paid, seller paid. It's all the same. Refundable, yes. Borrower paid, yes. And lender paid, no. That's never going to be refundable. They're just going to keep that. So, again, you've given them that money. You've deposited it with them. If you pay that loan early because refinance opportunity comes down the road or you sell the house, you're not getting that money back. The seller will keep that. The lender will keep that. This is not allowed on investment properties. And it does count toward interested party, only on the seller paid does it count towards interested party contribution limits. When you buy a house, it's very common, we're all familiar with interested party contributions, right? You can have the seller agrees to pay, let's forget about temporary buy-down context. The seller agrees to pay $5,000 toward the buyer's closing costs and prepaid expenses. And that's all well and good, and we see that all the time. It's very common, right? But it's not unlimited. The lenders do regulate that depending on, are you buying a primary residence, how much down you're putting, and that can range from, I think, 2% seller contribution to 6% maximum seller contribution limit, 6% of the purchase price. And so sometimes that number can be quite high, right? I've never seen actually seller contribution of 6%. And one of the reasons for that, it starts to potentially impact the appraised value, right? If the appraiser goes out and says, look, I see that this is, this house sold for $500, but the seller's paying $30,000 toward the closing costs prepaid, that starts to be a fairly sizable percentage and that might start to be factored in, to the appraisal limits. But just be aware that it does impact your contribution limits, and that can be particularly important if you're in the seller paid category here, because seller, if the seller is paying, if you got a 3-2-1 buy down, we saw previously that was $20,000. Well, that can be a fairly sizable percentage, and we might start to run into some of those caps, on the seller paid limits. So just be aware of that. So let's go here and just talk about, now these are some decisions that you're going to make. Now this, I'm going to assume here that we're going to talk about a seller contribution, because as I've talked about before, I don't think the buyer contribution has any value whatsoever, and the lender paid temporary buy down is also a very limited, if any, value at all. So really we're talking about seller paid, and here I just want to kind of illustrate and look at what are the other things you could do with that seller money, because again, we talked about earlier that the seller has $20,000 to give, let's say, and they're committed to that. They've already kind of agreed internally with themselves. Look, I'm willing to do this, and I don't really care how this buyer uses it. I really don't, right? You can use it any way you want, but I'm going to give that. So my question is, what else can we do with that? What else can we do, or specifically, what if we use that money instead of doing a temporary buy down, we did a permanent rate buy down? So let's start here with the 3-2-1. We saw that the cost at 7% for a 3-2-1 was going to be almost $23,000, almost $23,000. So you see the payment difference on the temporary buy down. This, for the first year it's $939, for the second year it's $642, for the third year it's $329. But what if instead you took that $23,000 and you did a permanent rate buy down? Because that's a big chunk of money. You can buy the rate way down for $23,000. And so that's 5.75. So now you get a permanent $409 a month reduction. And it does increase your qualification potential, right? Because this is a permanent rate buy down. This is an actual rate buy down. When you do a permanent, they're actually buying the interest rate down, and that's the rate that's going to apply throughout the life of this loan. And so, you can see that the payment difference isn't nearly as sexy as the $939 a month, but it's pretty substantial, and it's permanent. You're not going to deal with that payment shock every year, for 12 months, and then it's going to go up by another point, and then another 12 months, it's going to go up by another point. And then you get to that, third, fourth year, and now you're at the full payment, and hopefully you're prepared for that. And so I don't think I said this earlier. I'm sure it was implied in my comments, but you should never ever enter into a temporary rate buy down purchase with the need for that to be the permanent rate. You should never go in there needing to refinance in order to survive in that loan in the future, because that's just a very tenuous position to be in. People sometimes say you can always refinance later, and that is, that is absolutely a false statement. You can't always refinance later. Maybe the property value has gone down, maybe you've lost your job, maybe your credit isn't that great, or maybe mortgage rates just didn't cooperate the way you thought they were. So you should always go into your current loan knowing that full payment is your best case scenario, or that could be your best case scenario, and you need to be able to handle that, right? But if you permanently buy it down, then you've permanently made this your best case scenario, which is significantly lower. Now, why wouldn't you do that? Well, a couple of reasons. One is right now interest rates are quite high, and when interest rates are high, lenders a lot of times are more than willing to let you buy the rate down. They don't charge as much to buy the rate down lower than the par rate, and the reason for that is they expect rates to go down in the future. And nobody knows, right? And nothing illustrates the fact that nobody knows better than if you go back a year from now or 2 years from now and look at interest rate predictions by all the experts, and they were supposed to be a lot lower than they are right now, right? They have stubbornly stayed up high. Inflation is stuck around, and that's kept interest rates up. So nobody really knows, but it is indisputable that all the people that know the most about how these markets operate still expect rates to go down. Everybody expects virtually everybody expects rates to go down. When and by how much, obviously you see a lot of variation there. But when you expect rates to go down, why would you spend $23,000? And I've seen this happen. You spend a lot of money to buy the rate down to 6.75, and then a year from now, rates are down to 6%. You can get 6% for free. You could have refinanced from your 7% to 6% for free. And instead you've got, instead of 7% and 5.75, you've got about a quarter better than 6%, and you had to pay $23,000 to get that. And so be careful about spending a lot of money on points to permanently buy the rate down. The best time to buy the rate down is when rates are really low. The time to buy the rate down is when you're in your long-term home and rates are already really low. The time to spend money on points to buy the rate down is when rates were 2.75, right? Because then, if you're buying that rate down to 2, what's the likelihood that you're ever going to refinance that they're ever going to get below that? So that's the time to buy the rates down. But the problem with that too is that banks know that too. And so when rates are really low, then they charge you a lot of money to buy the rate down lower than that, because they know you're only willing to do that because you plan to be in that loan for a long time, and it's not likely that rates are going to get any lower than that. So they're going to have to honor that rate for a very long time. And it works in reverse too when rates are high. They're happy to let you pay cost in order to do that. So I would just say, see if there's a way to take advantage of those costs up front. But again, be careful about just saying, well, I instead of buying the rate down, I'm just going to take a $20,000 seller contribution toward my closing costs, because you may not have that much. And then you're forced to buy the rate down anyway with some of those costs. But that's kind of, I just wanted to kind of show you this illustration. And you can see whether it's a 3-1, 2-1, or 1-1, it doesn't change what the impact of that reduction is. It's 3% the first year, 2% the second year, 1% the third year. Or if it's just a 2-1, you see this 642 equals the 642 in the middle here. If it's just a 1-year buy down, it equals the 329 here and here. And that's kind of where it is. And then, of course, you have less money available. Here, the 2-1 only costs you 11.6, so you can only buy the rate down to 6.25 permanently. And the 1-1 here can only buy, it only costs you $3,900. You can only buy the rate down to $675. And then here that would be very little benefit, right? You can, you take that $3,900, you can permanently buy the rate down, but it only affects your payment by $84 a month, which isn't that much. Okay, so I want to move on. I want you to see some of the mechanics of this. This is a temporary buy-down agreement. This is what you're going to have to sign. And here, this is a lender paid. This is a lender paid, and the reason I know that is because this is just between the lender and the borrower, and it says here that to pay for a temporary reduction of the borrower's rate, lender has deposited, right? So this is a lender-paid temporary buy-down agreement. And they're going to show you this, and remember, this looks a lot like that chart where we calculated kind of what the cost of it was, and basically it's just going to be, here this is assuming a 1-0 pay down, because they only have 1 through 12, but this would be 13 through 24 and 25 through 36. And they would just do the same thing as we saw in that chart, here when we went kind of here. Ooh, sorry, I'm making you have whiplash here. It's basically this whole chart that we did over here. It's just here on this form. It's embedded in this form. And this is where you're going to see that. And I'm not going to get into all the blah, 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 but here's one thing I do want you to see is item 6 here. In the event that the debt is paid in full anytime before the disbursement of the entire buy-down subsidy, all remaining should be returned to the lender, right? So this is that lender-paid buy-down where that whatever's left over, if you refinance out of this house, rates come down, and you refinance out of this mortgage because rates are down, they keep it, right? So just be aware of that. Now this one is between the borrower and the buy-down payer, quote unquote. Now this form is flexible. This buy-down payer is not just the lender. It can either be the seller or it can be the borrower. Right? And we already said the borrower, that's silly. We would never want to do that, but this form does allow for that. And so here they say that we have item number 3 again, Article 3 on here says to pay for a temporary reduction of the borrower's interest rate, Buydown power is deposited with the lender. And here they say Buydown payer, right? And that's defined up here. And so here it would be seller or yourself, the borrower. And then here this happens to be a 2-1, right? This is a 2-1 because you can see they already included months 13 through 24 on here. Or it could actually be a 1-1. There are a lot of different ways to split these up. You can do a 1-1 buy down as well, where the 1% the first year, 1% the second year, and then full payment after that. 1-0, 1% the first year, and then full payment after that. 3-2-1 we've looked at. So there's all different ways of doing that. But then here's Article 6 again on here says in the event the debt is evidence is prepaid in full, any remaining buy-down subsidy shall be applied to the outstanding balance due on the note. So you're getting that money back. They're going to lower the payoff balance of your mortgage by whatever's left in there. So you're effectively getting that money back, anything that's left over. And that's why it's okay to go into, to take that $22,000 and take that and know that you're going to fully benefit from that money that the seller's paid. Even if you pay this loan off early, even if rates come down and you refinance out of this loan, that money, once it's deposited, once this loan closes, it's all yours. It's all yours. You're going to get that full benefit from it. Now, one more thing I want to show you here is just how does this look on your mortgage statement, right? How does this kind of look on the mortgage statement? And sorry for the kind of small print on this. This is an actual statement of one of my clients, but you can see here that they have the full principal and interest and escrow, right? Taxes and insurance, and then they don't have it bracketed here, but they say okay, less the buy down. And that's how they come up with the discounted payment on this deal. And then over here they show you the balance. This is the assistance balance that they call it. Now, different lenders are going to name it differently and show it differently, so just do be aware of that. But this is basically how it's going to appear on your mortgage statement and how it's going to be affected on that. And every month you'll see this amount go down, right, because you're going to use up that amount every month. But just know that if you were to refinance that balance would be applied against your payment. Hope I've answered most of the questions with regard to temporary rate buy downs. I'm sure there are things that I could have said more clearly, so please ask me questions, comment, like, subscribe.